Hey, richest you money maniacs. Will the stock market continue to crash in 2020? And even more important, will you survive it? Let's find out. Hey everybody, welcome back. I'm Tom from The Richest You. And unfortunately, the topic of this video is, will the stock market continue to crash in 2020? That's right, I am filming on Friday night after the Thursday and Friday devastating losses in the stock market.
Breaking news: concerns over the coronavirus outbreak, and once again they are affecting the stock market. Look at that right there. Wall Street ending one of the worst weeks of trading since the financial crisis in 2008.
Now, for a long time now, we've been doing videos on The Richest You about the dangers and the drawbacks, tax-wise as well as risk-wise, of being in the market at all, especially coming up to these last two particular days.
Major sector from technology to utilities have been hit and now sit below key technical levels. This sell-off is not just an American event by no means. Stock markets all over the world have dropped close to 10% or more in a week, and U.S. blue chips, as we mentioned, haven't had a week this bad since 2008.
And everybody had been talking about the crashes that are coming and the correction that the market needs to undergo, because all of the experts have been leading up to these last 2 days saying it's overinflated, it's overpriced, there's going to be a correction. It's been going on for way too long. Well, today and yesterday that occurred. In fact, yesterday on Thursday, the market lost over 1,100 points in one day. And then today it lost over 350 points again. Now, here's something that you won't hear, or at least I haven't heard from anybody else in any other videos. I actually spoke with my financial advisor today because I wanted to just double check on my laser fund. Now, in other videos, you hear me talk about the laser fund and how wonderful it is, because when there is a market correction, a laser fund doesn't lose money like other 401ks or Roths or anything else that's in the market, especially stock markets, common stocks or indexed funds and things like that, mutual funds. Anything that's in the market, when the market goes down, those lose money. My laser fund, that never loses money. So every time it makes money, that becomes part of the permanent principal that never goes down. So just out of curiosity, I called my financial advisor and I asked him, so how are things going there? Are you busy? Is the phone ringing off of the hook? And he said, well, no, actually, it's been really calm. There is one fella who works in a separate department in our office that works on, taking care of funds and stocks that we do for some clients. Some clients insist on doing that, and so we provide that service. And he has been on the phone frantically for the last few days, in fact. And of course, today is no different. However, all of the other phones in the office for all of our other agents who handle clients and deal with their laser funds, the phone has not rung once at all, because all of those clients know that their money is safe in that laser fund. So imagine for a second, we've been making videos for weeks now talking about there's going to be correction. You need to be aware of how to protect yourself using commodities or using something like a laser fund, or getting your cash into things that actually increase value for you, or having your money buy a business that actually generates more revenue for you, or streams of revenue. Remember, every dollar that you make should be treated as an employee that should go out and work for you nonstop to make you more money. Well, when you put it into the stock market, you would think that that'd be the case, except that there's always the risk of, number one, someone else taking that dollar because the price goes down. And of course, also, even when you do make the money, you have to give a huge chunk of that, a third or more, over to Uncle Sam. Now, I don't want to digress too much, but I can tell you this. After speaking with my financial advisor today, not only did it make me feel really at ease, peaceful in my heart and in my mind to know that my money is safe, and that the more I put in there, the more money is safe and protected no matter what the stock market does. but also I was able to get out of him something that you may not hear from anybody else. He made it clear that their office anticipates a huge sell-off over this weekend. We're talking about tomorrow and Sunday. And when the market opens on Monday, his office and all of his analysts and all of his experts anticipate another huge drop in the market. Now, the curious thing is that you're seeing a lot of videos right now online about how this is being caused and has been sparked or inspired by the coronavirus and the fear that the world feels right now about that virus running around the planet. But the fact of the matter is, this has been coming for a long time. This is the result of an economy that has been propped up artificially. Unfortunately, we are now reaping sowing the damage of prolonging waiting for that correction. In fact, it was Michael Burry who actually predicted the 2008 real estate crash in the subprime market, who predicted this crash as well. And I believe that he was accurate, because what I think we're going to find out after the dust settles is that his prediction about what he called passive investing is the reason that the market was so overinflated and became so dangerous. So what Michael Burry said was that passive investing has removed price discovery from the equity markets. So what does that mean? What is passive investing? First off, passive investing is basically known as a buy and hold strategy. So you're hearing lots of videos about people say just put money in the market and don't try to buy and sell. Don't get in and out, because then you get all those fees from the brokerages, when you're buying each time, and when you sell each time you get fees. Plus you get taxed if you do make money. And often what happens when you trade too often is that you end up buying higher and it goes low, and you sell again and you just panic. And a lot of people are emotional about stocks, and so they get out at the wrong times. So it's been really easy for a long time to advise people to just get in the market and just stay there. Just get in, because over the long haul, 20, 30, 40 years, the stock market averages a whopping 4% before taxes over 20 to 30 or 40 years. Now, that means 20, 30, 40 years you've been giving your money to the stock market, and they've been taking it elsewhere and turning that into 10, 50, 100%, 200, 1,000% in return for themselves, because they actually understand how money works. Now, they probably do some long holding also, but really it's the general public that are taught to just put it in and leave it in there and just trust the experts that over that huge long period of time that your money's just going to grow by about 4%. And don't worry about that the taxes will be astronomically higher 40 years from now, because taxes never go down. But that's a whole nother video that I've already done. So really what I want to focus on right now is that's passive investing, except that we've taken it another step. We don't just passively invest in common shares anymore, which is basically in one company that you believe in. Let's say you really believe in Tesla and you know their stock's going to go up, so you just keep buying Tesla for 40 years and that's all you buy. No. People don't want to do that, because, well, then you've got all your eggs in one basket, and what if something happens to Tesla? Well, then you're out. You lose all of that money. So what they've done is they said, well, diversification is your friend. So they created things called mutual funds, and then they actually created things called indexed funds. Funds that are indexed against markets as if it's a common stock. What does that mean? It means that you can buy an indexed fund that acts, a share of an indexed fund that acts like it's a stock, even though it's really just indexed against the S&P 500 or the NASDAQ or whatever. They pretend that it's like a stock and that you're buying this S&P 500 indexed fund like it's a stock, and then you just hold on to it. You just hold on because it's a whole bunch of different companies in the S&P 500. It's all of these great companies, and everybody knows that all the companies that are in these markets are good companies, or they wouldn't be public, right? Well, that's exactly what people thought in 2008 with the subprime mortgage challenge. They were buying subprime mortgage packages from banks. They were putting stock or investing in subprime mortgage packages that were rated AAA, because they're told that for it to be rated AAA, 90% of those mortgages have to be AAA mortgages, or the best mortgages. Now, what's a best mortgage? It means that somebody is actually making the payments. They're not late, they're not delinquent, they're not foreclosing, right? They haven't missed any payments. They actually pay on time. Sometimes they pay early and they pay a little bit more. That's a AAA mortgage. And so this mortgage package that we're going to sell you to invest your money in has 90% AAA mortgages in 2008. That's what they did. Except that when this Michael Burry actually did his homework, what he discovered is they were not 90% AAA mortgages. They were more like 10%, and the rest were a few Bs, more C's and D's. The worst kind of mortgages, the kind that are foreclosing, the kind that have missed several payments, the kind that pay late all the time. So people were putting their money in something that they were being told was true when it was not true. It was completely false. This is exactly what's happened right now with indexed funds. Michael Burry called it out because it's the exact same pattern with indexed funds, with passive investing. People are being told that this fund always performs well, and so nobody does the homework of looking at each company in those funds to make sure they're AAA companies. Nobody actually goes and does the research and the discovery to find out if those companies actually are going to keep building and growing. Maybe they're actually not AAA companies anymore. Maybe they're not being run well anymore. And once it reaches a certain percentage and a certain tipping point, the numbers don't lie. Doesn't matter how hard you try to prop that up. As an index fund, there's just too much money to prop it up. It's going to eventually, like a house of cards, completely collapse, just like the subprimes did in 2008. That's why Michael Burry called it, and that is exactly what we're experiencing right now. It is not the coronavirus. Unfortunately, what's happening with the coronavirus in the news is it's a look over here, look over here. It has nothing to do with the fact that in 2019, we lost over 1,000 CEOs and corporations that were in those companies, in those indexed funds. And you can look that up on ccn.com. Not only that, but insiders of these corporations have been dumping company stocks for quite a while, for months and months and months. They knew, because they were insiders, that the companies were not AAA companies in these indexes. They knew, because they were working at the companies, that these companies were not financially responsible. And so they started dumping their options. Remember, we talked about options. A lot of CEOs get paid a salary to come on board, but then they're also given significant stock options that they can buy and sell later. That's in another one of my videos, so make sure you watch that one to explain that, how that works. So these insiders have been dumping stocks for companies in these indexes for months, and the CEOs and C-level executives have been jumping ship for quite some time, since last year. They knew that these indexed funds it was a bubble that was going to pop. They knew that the companies that were in these indexes were not AAA companies, that they were in jeopardy. And now the coronavirus has only just been the excuse for the market to completely crash. Now, what does that mean when the market crashes? It means that the major players are taking their money off the table. They've let the price go up as much as they feel like they can get away with, and they sell. And when they start to sell, everybody looks around and goes, wait, why are they selling? They're a major player. Why are these huge stakeholders selling in all these different markets? Well, I got to get out too. We better sell. And then even worse, you have the robots that start to sell too, because as soon as it hits a certain price, they're programmed to just click sell, and it just compounds. It just goes and goes and goes and goes. And I believe that's what my financial advisor meant by this weekend. There will be a huge sell-off so that Monday you'll see another distinct drop in the marketplace. Now, that's what's occurring. So it's not really even the coronavirus. This is Michael Burry's prediction blowing up in everybody's face, proving that he was right again. He called it and nobody listened. Everybody thought he was crazy, except for all the CEOs that have quit and except for all the insiders who have decided to dump their stocks. So what does that mean for you? It means that you really need to start studying where to put your money so that it retains its value. Money is, as I discussed in one of my other videos that just went up recently, money is the abstract idea of value that humans assign to goods that they exchange. Currency is just the medium of exchange. It's the piece of paper that we use because it's more convenient than handing you a cow to buy corn. All right, so watch that video so that you can understand this next part very, very clearly. When you protect your money, your value, you've worked, you provided service, you provided goods to your employer or to somebody to get value from them. They gave you that money in the form of currency. That currency is in jeopardy now because the stock market is crashing, the economy is going to suffer, and the dollar, which has almost no value now anyway, is going to drop because of it. People are not only panicking about the stock market, they're panicking about the coronavirus as well. And so the currency that's used to exchange value is going to lose value, and people are not going to have faith that it's stable. The market and the economy have to be stable for the currency to remain stable because there's no real value behind it. Now that's part of that video too. Our US dollar is fake money. It's fiat currency. That means there's no gold or silver behind it. Now, if you want to know what to do with your money, well, then you need to learn where to put your value, your money, so that it retains that value. And that typically is things like commodities, gold, silver. In fact, a friend of mine actually said, oh, I'm going to start buying whiskey barrels. How about that for an idea? Because it takes 10 years for whiskey to ferment properly, and so those barrels become investment opportunities for people. That would retain its value because it takes the same amount of time, the same amount of wood, the same amount of ingredients to make good whiskey. That's a good investment. That's a good example of a commodity. Now, some people would say, oh, well, if the stock market is not doing well, I should put money into municipal bonds. Except that all of the governments across the entire nation, in fact, I would even take it this far. I would say that all of the governments around the world are actually broke. So putting money in municipal bonds in governments that are broke probably is not a good investment. You may not get your return. You may not get anything back. Now, of course, they're required by law to pay you back, but if they're broke and it gets worse and they never stop their spending, is that a good investment? I wouldn't say so. I would encourage you to especially look closely at a laser fund. And I know that it sounds like I'm beating a dead horse, but the fact of the matter is I'm living through the crash right now with you, and I'm going to sleep really well tonight and all weekend. In fact, when Monday happens and the market goes down more Monday night, I'm going to sleep even better because I know my money, my value is safe. Now, where you're going to go to look this up is liveabundant.com. There's going to be a link down below in the description, and you're going to go to that website and you're going to start reading about Doug Andrew, 45-year veteran in financial advisement, and you're going to read about Emran and Aaron, his sons, and you're going to learn how this laser fund actually works. It's a universal life tax-advantaged insurance contract that's indexed against the markets. So it's indexed like an indexed fund, but it's not in the market. And because it's an insurance piece, when the market goes down, it only produces 0%. It doesn't go below zero. So your principal always stays secure. Now, this video is not about how those work. Watch the video where I describe that, and actually I'm going to be doing a series of videos that explain the difference specifically between a laser fund and other types of retirement interest investments like a 401k or a Roth or annuities or different types. And I'm going to list specifically why the laser fund is better. So watch for that video also. Now, listen, everybody who's out there watching this video, this is a timely video. This is Friday night. Thursday, yesterday, the first part of the crash happened, over 1,100 points down. Today, over 350 points down. And then Monday, you watch what happens. So I just hope that you all got to see this before the ripple effects of this crash get far-reaching, because that's what people forget. They read in the news that the numbers went down and there was this terrible crash, but they don't really understand it until it's too late, until they're out of a job, until their retirement money is gone. Now see, that's something you got to take into consideration too. Think about this for a second. Maybe this will help you connect the dots. All the baby boomers who have their money in the stock market, their retirement money, 401ks in particular, are required when they hit 70 and a half to pull out of the market, right? So the government doesn't care. The federal government requires you at 70 and a half to pull your money out of the market. They don't care if the market's up or down. Guess what? It's down, and it's down a lot, and it's going to be down for a while. Remember, in 2008, it took 4 years for people to get back up to zero. That means they lost 4 years of making any gains on their money. This one is far worse, and it's going to take even longer to recover back to zero. So think about this. Someone who has to pull out their retirement now by federal law and are going to get taxed on how much they lost, right? They lost money, so that little chunk they have left, they're going to get taxed on even more than when they first made it. They're going to be looking for work. So if you're graduating college and you're watching this video and you're listening to me right now, your new competition for finding that job just so that you can pay for your college debt is going to be your grandfather, because he's going to be looking for a job too. This is what happened in 2008 that people just don't seem to remember. It wasn't that long ago. 2008, suddenly all these people came out of retirement and had to start working again because they had no money in their retirement. So think about just how these dots all connect together and how it's going to directly impact whether you have a job and whether you have a place to live and whether you can afford just to feed yourself. Take the coronavirus out of it completely. Those challenges alone should shock you to the core to at least inspire you to go to liveabundant.com and look up exactly what the laser fund is and start studying very carefully how to protect the little bit of value that you have right this second, because you have a little bit of time before the waves of destruction from this crash reach everybody. Now, some people it's going to hit them faster, and some people aren't going to even know, and they're or maybe they have their money in different areas, and so they can move it quick enough and protect it to be able to save themselves. So I encourage you to go and do more homework, and if you have questions about it, make sure you comment down in the comments below. In fact, if you want to learn more specifically about how money actually works, definitely hit the link in the description for our course, The Richest You Mastering Money. And if you like this video, please give us a thumbs up. And of course, we always encourage everyone to subscribe to our channel so you know when we put up new videos as well. So we wish you all well. I hope that you take this seriously and go look up what a laser fund is and how to get yourself into it and protect your money. Thanks for listening, and I look forward to sharing with you again real soon.